Welcome to the Capital News. I am your host, Alex Corrales. Today is July 2nd, 2019. Thank you so much for joining me. Title of today's episode, Bipolar, Black Gold. And of course, I'm talking about the oil market. What took place today with the stock market? Well, the S&P closed up 9 points. Closed up higher than it did yesterday. Yesterday was a record close. That means today was another record close, closing up 9 points. The Dow gained 69 points. The NASDAQ gained 18. All of these three indices averaged about 0.2% of a gain, up to 0.3% of a gain. The Russell 2000, the small cap index, lost 9 points, representing a decline of 0.6%. The Dow Jones Transports also lost 0.8%. The New York Stock Exchange gained 0.2%. Now, interesting to point out is the fact that despite the fact that these markets, the S&P, the Dow, and the NASDAQ, closed higher, they were trading in the red throughout most of the day. But at the end of the day, like we've always said, you got to pay attention to that last hour, half hour, even 15 minutes as of late to see what takes place. And there was, again, another little mini rally within the last few minutes of today's trading session. The S&P gaining, the Dow, and the NASDAQ again. The Russell was down slightly over 1% at its lows during the trading session today, but it too caught a little rally at the end of the day and only lost 0.6%. However, if we look back over the course of the last few days, really, we've seen the Russell 2000 drop, we've seen it gain back a lot of those losses, and now it seems to be giving some of those back once again. We had, of course, the trade truce. It appears this truce is running out of juice because you had the markets rally very aggressively through the month of June, hoping that there was going to be some sort of trade talk, some sort of truce following the G20 summit, which there was. Also on the backs of hope that the Federal Reserve will once again come to the rescue, whatever this means, and cut interest rates. At least 25 basis points. Boy, wouldn't it be fantastic if they would do 50 basis points. Hell, even the president's out there saying, I want 100 basis points, 1 full percent. Can't make this stuff up. That's where we are. We're going to see what happens. You know, typically the markets are said to be forward-looking. They're supposed to have these things priced in. I don't like using that lingo, by the way, but that is the lingo. All this stuff's supposed to be priced in. You could have had, buy the rumor, sell the fact, which we talked about. You had markets the world over rallying on Monday. Now a lot of them either giving back or doing sort of like the American exchanges have today. Just little gains, maybe even some of them slightly down. We're going to get to that. We're going to get to some of the trading that's taking place right now as I'm doing this podcast. These are things to pay attention to. Because where is the catalyst for this melt-up? It exists. It most definitely exists. It can happen. We're in the financial world of Oz, as I like to say here. But now the markets are starting to pay attention to some of the underlying fundamental economic data, and they don't like it. They do not like it. That's why they want the Federal Reserve to come to the rescue. Despite the fact that you have the president continuing to take to Twitter, even did so today, maybe even a couple times today, but I know at least once, saying that this is the best economy ever in the history of the United States. You can't make it up. Okay, so we had 3.1% GDP growth in the first quarter. Was it because of a strong consumer? Nope. Those numbers were downwardly revised. Was it on the back of exceptional business investment? Nope. Exports, imports? Okay, we're trading some. Okay, maybe it wasn't as big of a drag this time as it has been. We're in the midst of a trade war. Plus, we have slowing global economy. So you're likely to see that take less of a dent, be less of a drag on U.S. GDP. So where did the rest of it come from? Where did the pickup in GDP come from? It came from Uncle Sam. It came from government spending. It came from state and local government spending. You remove that from the equation, we're in a lot of trouble. That's what I talk about. I appreciate the fact that President Trump was able to get through some tax cuts, but he didn't pay for them. Why? Because I think he knows well, or at least a member of his economics team does. Look, Mr. President, we like the tax cuts and all. I mean, it's good political points. Everybody likes a little more change in their pocket, no doubt about it. But guess what? If you cut spending too, your GDP number, which you love, is going to take a hit. Because the change in GDP spending from year to year goes into that calculation. So there was no cuts to Uncle Sam's budgets. There's nothing serious. We have trillion-dollar deficits. It's a joke. In supposedly the best economy in the history of the United States. Doesn't make any sense. And you have the president himself and the administration coming out aggressively telling the Federal Reserve what to do, namely cut interest rates and sometimes embark on another round of quantitative easing, which simply means just print money out of thin air, monetize our debt, and everything will be fine. Of course, the president used to demonize this. I continue to demonize it because it's not right. It's a fraud. You go print money to pay your debt, see what happens to you. They'll lock you up and throw away the key. But no, Uncle Sam can do it. The government can continue to do it. They can waste our hard-earned tax dollars. They can tell us there's no inflation to our face, but we know otherwise. People go shopping. They eat for a living. Living paycheck to paycheck, a lot of Americans are. You got people working 2-3 jobs, still having it tough to make ends meet. That's not exceptional. That's not the greatest economy ever, anywhere. That's pathetic. But that's where we are. And I don't lay this at the feet of Donald Trump. This, again, was a foolish mistake in my analysis for the president to take ownership of the economy. And most definitely a ridiculous move to take ownership of the stock market. It's not his job to take ownership of either, especially when it is in such poor shape. Not his doing. This was administration after administration after administration. This was Congress after Congress after Congress's doing. This is the nepotism. This is major corporations being joined at the hip of government. Basically having laws written that protect them when they commit a crime. It would be a crime if we committed it. They get a smack on the wrist, if that. This isn't Donald Trump's doing. Why he took ownership of this is anybody's guess. I mean, he's delusional on this. It drives me absolutely insane. Because he could have been on an educational tour for the past 2.5 years, educating the American people as to what's been taking place, which I thought he might actually have done, which is one of the main reasons, again, why I voted for Donald Trump. Because that's what he used to talk about. He used to say the Federal Reserve was causing bubbles. This was a fake economy. Now he's president and he's kingpin. Everything's fantastic. Never been better. Let's cut interest rates even more. Let's get them going. It drives me absolutely insane. Absolutely insane. So it lowers interest rates. What's that mean? You have a lower payment? What happens if you actually had an economy that worked and you had prices correct? Maybe that would be even better. Why don't you do the math? You want to go buy a house for $200,000 right now? You say, oh, well, honey, look, the interest rates are pretty low. What happens if you had markets correct and you had markets that function like they're supposed to? What happens if that $200,000 home became $150,000, even if you had a little bit of a higher interest rate? Do the math. You'd come out way ahead. You afford the asset, not the payment. That's the problem. Everybody thinks they can afford something because they can afford the payment. And most people can't even do that. Whether it's a new fancy car, that the average, I think, is around $33,000, $34,000. We talked about that the other day. An increase of 4% year over year, by the way. So much for no inflation. That adds up to about $1,300 a year. You have an extra $1,300 in your pocket? Probably not. Most people don't. But there's no inflation. You don't pay any attention to that. But we can afford the payment because interest rates are low and I want a new car. Okay, well, we'll see how long you last. Good luck to you. We know how that worked for 7 million Americans who are 90 days plus past due and counting, behind on their auto loans. So obviously, it ain't working out, folks. It ain't working out. Oil, pretty much the theme of today's episode, dropped. It was down, I think, at its low point about 5% for the day, which is a huge drop for the oil market. We have WTI trading at $56.44 a barrel. We have Brent crude trading at $62.84 a barrel. We have gold, which caught a nice bid today, now trading at $1,430 an ounce. So it was just the other day we were below $1,400. and now we're at $1,430 an ounce. Silver remains above 15, trading at $15.38 an ounce. Uncle Sam's 10-year Treasury, geez, this thing just keeps whipsawing. It lost 2.8%. It is now yielding 1.976%. 1.976. So we lost the two handle. We are back with the one handle. How much lower can she go? Oh, she can go a lot lower, believe me when I tell you. Will she? That's the question. You have all this manipulation. You have bond yields, which we're also going to talk about today, because something we have been noting here as of late is interest rates around the world that have a negative yield. So we're going to talk about that. We have the VIX, the volatility index, getting clobbered today, losing 8%, and is now trading at $12.93. That's a huge hit on the VIX. I told you we got to pay attention to this, because rarely does it stay down this low for this long. Usually it snaps back, and if it snaps back, it's usually at the hands of some sort of market sell-off. It doesn't mean it's going to be a collapse by any stretch of the imagination. That's not what I'm saying. But a pullback, if it comes, don't be surprised. One of the things I think I discussed briefly yesterday was the fact that the Reserve Bank of Australia had their monetary meeting where they set interest rates, and lo and behold, they continued to cut their interest rates as they did last month to a record low of 1.25%. Now they are at 1%, so they cut another 25 basis points. No surprise here. We've been talking about Australia for a long time, folks. It's on our list, amongst many, many other things. A lot of people want to believe they're immune, that they can just keep chugging along without hitting a recession. So they don't even necessarily have to hit a recession, but they are definitely slowing down. If they go into recession, I'm not going to be surprised, because you have a global economy that is slowing down. You have China that is slowing down. That's been Australia's goose that's laid the golden egg. It's slowing down. So by extension, Australia is going to be slowing down, because they're a major exporting nation. They got a lot of natural minerals, natural elements. So they're going to slow down. That's what's going to happen. Pay attention to it. Now, again, no surprise to us. You have some mixed data that continues to come out of Australia. Australia posts the largest trade surplus on record. You would think that would be good news. But if everything's so fantastic over there, then why is the Reserve Bank of Australia cutting interest rates? What are they concerned about? These are serious questions to ask. This leads to some other interesting game theory, if you will. What's the Federal Reserve actually going to do at the end of this month? Will they cut rates? You have central banks all over the world, even in developed countries, such as Australia, cutting interest rates. You have the ECB standing on standby, ready to once again intervene. They already have negative rates. They're going to go even lower. They'll embark their QE, quantitative easing methods. I'm not making this stuff up. So this means, well, what will the Federal Reserve do? Because you already have a whole bunch of other central banks doing their dirty work, if you will. Let's just let that liquidity make its way through the system. It can go everywhere. Just because it's the European Central Bank doesn't mean that money can't make its way over to the United States. Just because it's in the Reserve Bank of Australia and they're funneling it through directly to the Australian economy doesn't mean that money can't make its way over here. And round we go. So maybe they say, well, everybody else is doing our dirty work. We've been jawboning the market, just simply meaning we're talking the market down from the perspective of we're going to cut rates, but they haven't actually done it yet. But nevertheless, they still have an effect from coming out and saying as much. Remember, doing a 180 back at the end of last year caused a V-shaped recovery in the stock market. Well, all right, we're not going to cut interest rates. It's going to be wait and see. That alone gave us a V-shaped recovery. It's complete fraud. It's complete abuse of power. But that's the world in which we live. That is the system. So they've been jawboning this market. They've been saying, yeah, we hear you, we see you. But there's still data. We're still data dependent. We're still looking at some of this stuff. We'd like to see more data. 1 month doesn't make a trend. We'd like to see a few months, maybe even 6 months worth of data on a few points that we really focus on. That was from Chairman Jay Powell during his last interview or speech that he gave there. So 3 to 6 months, that's not going to be this month. I anticipate that the Federal Reserve is more likely than not going to cut this month. But I am not going to be surprised if they don't. Because with all of their jawboning, with all of their talking down the market in respects to interest rate cuts, the market's already sort of followed suit. You have the 10-year Treasury below 2%. You look across the yield curve, it's ridiculous. It's ridiculous. It's inverted. You have some parts that are steepening. That's by design. But you have most of it that's inverted, which is a signal of an oncoming recession. Again, it doesn't mean it's imminent. It doesn't mean it's coming tomorrow, next quarter. But if history repeats itself, or if history rhymes, we are likely to be in recession this time next year, if not earlier. And by the looks of all of the other economic data that we talk about here on a daily basis, particularly the data surrounding manufacturing, and a lot of the ISM numbers and a lot of the PMI numbers that we talk about here constantly, they are rolling over, not only in the United States, but around the world. This is not going to flip on a dime just because central banks the world over are injecting more liquidity into the market. This is not going to flip on a dime just because there's a trade truce. There's no trade deal. Neither side is in any hurry. So we're told. I believe that to be true of President Xi. I don't think he was ever in any hurry. He just had a deadline and a threat of tariffs, punitive tariffs being placed on him before. Now there's no deadline. It's indefinite. So what's the rush? President Trump wants a great deal. He wants it to be tilted in the favor of the United States. I get it. Hope he can pull it off. Really do. But what's China's incentive to come to the table? Not too much. They just got away with the president saying that, well, Huawei's a national security threat. Yeah, well, you're going to have to continue trading with Huawei because, that's what we want. Okay, we'll continue trading with Huawei. Now, of course, we're told that the U.S. companies are not going to give away great technologies. What we're going to continue to sell to Huawei, if we sell anything, is just going to be common material. Just common elements or anything, common equipment that they can get pretty much from anywhere. So why should we hurt our U.S. companies from doing business with them on these, I guess, items that would not classify as some sort of national security threat? So President Xi pretty much got what he wanted. I guess it's sort of, in a way, it amuses me anyway, the stereotype of it. You got a loudmouth American and a quiet Asian. Now, it's going to be interesting to see, because we've been talking about what happens if the Chinese start speaking up. Because it's all been one-sided. It's Trump, it's Larry Kudlow, it's the trade representative Lighthizer, it's Peter Navarro, it's a whole bunch of people from his team. It's Treasury Secretary. Those people have been coming out. That's what we hear. The Chinese really haven't been sending that many messages out. Now, all of a sudden, we already have a couple. And it's only been a couple days since this truce was announced. They said, well, it's going to be a long haul. It's going to be a long road. And yeah, we know that companies are leaving China, but we're okay with it. Now, whether or not that's true or not, whether they believe that's okay, again, you're in any type of conflict, any type of war, the truth is the first casualty. But I told you we have to pay attention to these types of contradictions. Now, getting back to oil. Whoa, real quick, before I forget. We have Christine Lagarde, who is currently the managing director of the IMF, the International Monetary Fund. She is now being nominated to be the next president of the European Central Bank, the ECB. She will be the first woman to be the president of the ECB, should she actually become the president. She is, I believe, stepping down from her, I don't know what you want to say, from her current position as the managing director, based off of discussions with her ethics office during this nomination process, during to see how, whatever they do, if she's going to get vetted, she's got to get voted on, whatever the process is. Nevertheless, the point I want to make is the fact that this woman was convicted over fraud only a few years ago. Here's the headline from a few years ago. Christine Lagarde convicted IMF had found guilty of criminal charges over massive government payout. But the former French finance minister, who faced potentially 1 year in jail, will not face any punishment. And of course, we're not talking about chump change here. We're talking about 400 million euros. Okay? You probably don't have that in your mattress. Criminals. Criminals are at the helm. How many times do I have to say it? Criminals, I guess, trust criminals. No ifs, ands, or buts about it. I mean, this woman has been successful from a career standpoint in having title. How effective she's been in these positions, anybody's guess. You can have that debate. But what we do know from previous rhetoric is that she has called on central banks the world over from her position of authority as the managing director of the IMF, coming out and telling central banks, hey, look, the global economy is slowing down. You're going to have to stand ready to do things. So does that mean she's going to be a dove if she becomes the president of the ECB? Now, again, she's one voice, she's one vote. But nevertheless, that vote, the fact that she may very well be the face of the ECB, that carries weight, just like it does for Jay Powell being the chairman of the Federal Reserve. He's one voice, one opinion, one mind, one vote. But maybe he carries a little more weight because he is the face of that organization. I mean, this is going to be a race to the bottom. A race to the bottom. I've been saying here for a long time, pretty much since the start of this podcast back in February, that I anticipate the euro to pretty much get decimated. It'll trade at parity with the US dollar. I am expecting that to be the case. It will not happen overnight. But as things transpire, as we move along, as we see further economic data deteriorating, we just wrapped up the second quarter of 2019 already, so we are going to be in the midst of earnings reports. I think starting, really, it'll get busy in a couple weeks with companies reporting their Q2 results. We already know from forward guidance that we are not anticipating a great earnings season by any stretch of the imagination. Now, it's still early yet, given the amount of companies, particularly if you're looking, at the S&P 500. You got 500, maybe even a few more. I think there's actually 505 companies that comprise the S&P 500, if I'm not mistaken. So, but nevertheless, you have a sizable portion, as of today, that are saying kind of look out below. Not that it's going to be terrible, but it's negative. It's below some of the average forecast, the average analyst estimates. So are we going to be within this earnings recession? We very well could be. That doesn't mean it's the end of the world. It doesn't mean there's going to be a major market sell-off, but there could be. There could be, and this is stuff that we have to pay attention to. This is stuff we have been talking about for a while. This is why central banks the world over are getting ready to prime the pump again, because they're concerned that they're running out of juice. Diminishing marginal returns are starting to step in. Now, getting back to oil here to wrap up this podcast. It's up one day, it's down another. We had yesterday an announcement from OPEC in Russia that they're going to continue with their production cuts. Despite that, oil really didn't catch a major bid. Now today, at its low, it lost 5%. I mean, what's going on here? Again, folks, demand, supply, strength of the dollar, geopolitical tensions. On the demand front, I continue to remain firm in my analysis and in my opinion that the global economy is slowing down. That means there's going to be less demand for oil. Period. End of story. Don't overcomplicate it. Supply, you still have the United States pumping it out of the ground like it's going out of style. Why? Because we have the technological know-how to do so. We have the resources throughout this country's territories. And because a lot of companies are just riddled with a ton of corporate debt. A ton of debt. And if they ain't pumping oil and natural gas out of the ground, they're not selling. And if they're not selling, they have no cash flow. And if they have no cash flow, they're not making those debt payments. And if they're not making those debt payments, they're defaulting. Get my drift? Get the picture? They're not going to stop this. Otherwise, you're going to see massive amounts of bankruptcies, and it's going to start with the oil sector. If that happens, it might still happen if you continue to see a downward slide in the price of oil. We also have geopolitical tensions, don't we? Because despite the fact that you have Saudi Arabia and the rest of OPEC and Russia coming together to continue production cuts, well, when you have the rest of the world with now technological know-how, and the United States becoming the largest producer in the world, by the way, they're becoming less and less effective as we move along, meaning OPEC, which is a good thing. It's a good thing. You don't want any type of cartel. That's what the Federal Reserve is. That's what all these central banks are. They are cartels. They are trying to control the cost of capital. Cartel, OPEC, they're trying to control the price of oil. Not good. I'm consistent, see? So what does this mean for geopolitical tensions? Can there be some sort of false flag attack? Because we've already had 4 oil tankers hit back in the month of May. We had 2 more hit last month. We have, at least in rhetoric, that is escalating between Tehran and Washington, D.C. We have the USS Abraham Lincoln over there. We've just sent F-22 stealth fighters over to that region as well. I mean, look, folks, this gives me concern. It seriously does, because you have economies over there in the Middle East, particularly Saudi Arabia, that needs to have oil at a certain price to maintain their government, to maintain order. They don't want chaos. And to boot, they don't like the Iranians, and the Iranians don't like the Saudis. Furthermore, the Israelis don't like the Iranians, and the Iranians don't like the Israelis. And we're buddy-buddy with the Israelis. Trump gets along great with Prime Minister Benjamin Netanyahu of Israel. President Trump seemingly gets along very well with the Crown Prince of Saudi Arabia. So what's going to happen here? We talked on the political podcast today, is war inevitable? Is it? It's a serious question. We had previous podcasts where we said when all else fails, go to war. That was sort of tongue-in-cheek. But if you understand history, that's what happens. Your economy's slowing down, things aren't going right for you, you got a political mess here or there, whatever may be the case. Let's distract the people, let's go to war. Or let's start a conflict. Let's do something, let's escalate, let's distract the people. Because everybody loves to focus on war and conflict. Don't look over here with what's going on with your daily affairs. You're struggling to pay the bills. We're going to war, we got to rally together, we got to be patriotic. I hope we don't go to war. I really and truly hope that we don't. But when you have the price of oil that's coming down, when you have nations in the Middle East that we're buddies with, that we're pals with, they don't like the Iranians. They're already saber-rattling as well. The Saudis are against the Iranians, saying, look, Strait of Hormuz, this Persian Gulf, the Gulf of Oman, this whole area, I mean, we're concerned that the Iranians are going to do something. God forbid they do. We already know from tweets and statements from the president in response to remarks coming from Iran that if anything American is interfered with or attacked by the Iranians, that the Iranians face obliteration. That's not my word, that's the president's word. He was called mentally challenged. He threatened to obliterate Iran. That's the rhetoric. This is the world we live in. This is not kindergarten class. This is high-stakes politics. This is war we could potentially be talking about. So oil has been bipolar. It wants to rally on a trade truce. It ran out of juice, as did a lot of stocks, which we're going to wrap this up with that. We're going to do a quick around-the-world wrap-up with what's going on right now. But pay attention to the price of oil. Pay particular attention to what's transpiring in the Middle East, because you have this type of saber rattling. You have a major show of force right now in that region. And like I have been saying consistently here for the past couple of months, when you send those types of forces, in my opinion, you increase the likelihood that something can go wrong. Let's pray that it doesn't. So a quick look around the world here with some of the major indices. We have right now the Japanese markets are open. They are down about 0.7%. Nevertheless, throughout the trading day, we did have the European markets close up. The FTSE, the UK exchanges gaining the most, about 0.8%. The German market, relatively flat. Same with the French. Same with the Italian and Spanish markets. The Shanghai Composite is also down about 0.8% as I'm doing this podcast. Now, real quickly, with just a quick recap with some of these negative yields, which we're going to be talking about this a lot here because this ain't going away anytime soon. But we have right now just a quick glimpse of some of the major economies and their 10-year bonds. We have the UK 10-year bond yielding 0.73%. 0.73. We have Japan yielding negative 0.15. We have Germany yielding negative 0.37%. We have Sweden yielding 0.02. We have the Netherlands at negative 0.2%. And down the list we go. We even have France right now. They just touched negative territory. My goodness. Record lows on these yields. No end in sight. This is a race to the bottom. You cannot make this stuff up. This is zombie companies, zombie countries all over the world because nobody wants to take responsibility and tell you the truth. You don't need all of these people. You don't need the financial mainstream media. We have been predicting this since we've been on air in February. You don't need them. You need the Capital News. This is Alex Karitis. Godspeed.